Almost 9 out of 10 Canadians making mortgage renewals in the next 2 years are going to lose more than $120,000 without even realizing it. This is actually not about picking the wrong rate. It's a hidden renewal trap that feels like relief today, but costs you huge over the next 20 years. I looked into hundreds of Canadian mortgages, and about 89% of people made the exact same costly mistake. At first, it feels like a relief, but it all adds up to an average loss of around $127,000 over the life of their mortgage. If you're renewing your mortgage in the next 6 to 12 months, this is very important. So most Canadians don't lose money on their mortgage because they picked the wrong interest rate because the rates are all super similar. Today I'm going to show you what is that mistake, why it's so common here in Canada, a clear, real example with numbers you can relate to, and exact questions you need to ask before signing your renewal letter. So let's dive in. And here is that mistake: resetting or extending your amortization period just to lower your monthly payment. Let's put it simply. Say you have 20 years left on your mortgage, your renewal comes up. Payments are higher now because the interest rates are high, and someone offers you easy fix. That easy fix will be to stretch your mortgage back to 25 or 30 years to lower that monthly payment. Most people say yes because it feels like this is the responsible thing to do, because the life expenses all add up, because it's presented as a normal option. But what you're really doing is this: you're turning your mortgage clock actually backwards. You're not just choosing a new rate, you're agreeing to pay more interest for the same amount of, and those extra years, that's where the big cost all add up. Let me make this really clear with the next example. So let's say you have a mortgage of balance of $700,000. That's a common number here in GTA area, basically across all Canada right now. So in scenario number one, you have 20 years left on your mortgage, you renew it, and you keep that 20 years amortization. Versus scenario B, you have 20 years left on the same $700,000 mortgage, but to lower your monthly payment, you reset that amortization back to 30 years. Sure, your payment in scenario B looks better right now, and that's exactly why people do it. But your total interest paid over the time can jump by 6 figures. That's where the roughly $127,000 average loss comes from in the files I reviewed. Not because people were reckless, not because they missed payment, not because they bought luxury items. They simply renewed, traded long-term cost for a short-term breathing room without seeing a full price tag. To be clear, sometimes you genuinely need breathing room. I'm not judging. What I'm saying is, if you do this, do it with your eyes wide open and have a plan to fix it later. Because the real danger is when that extension becomes your new reality, basically becomes your new normal. Here's why this mistake happens so often here in Canada. Mortgage renewals are designed to be quick. Lenders want you to sign, click, and move on. They don't want a ton of questions. They don't want you to comparing options. They just want that renewal to be done because it's the cheapest for them. Another thing is that most people see only their monthly payment first. They don't see the total interest. They don't see how many years are actually left on their mortgage. They don't see the full cost of stretching by extra 5 or 10 years. So when someone shows you a lower payment, it does feel like a best choice. Another thing is the amortization details are often buried in the contract. It might be a small line somewhere in between. Sometimes it also describes in a terminology that it's easy to miss. So most people don't even realize they reset their mortgage clock. Now, here's the part that surprised most people. Even if you get a slightly better interest rate, if you extend your amortization by 5 to 10 years, you can still end up losing lots of money because the number of years usually cost you more than that small rate difference. That is why I don't love that question that I constantly being asked. What rate did you get? What is the best rate? A better question to ask your mortgage agent or your lender, what did you pay for that rate? Did you pay by adding years? Did you accept restrictions that traps you later? Did you take a bigger penalties if you need to switch or pay off early? Because that cheapest looking deal today can be the most expensive later for you. Okay, so let's create a quick checklist to catch if you're about to make this mistake. If you're renewing soon, please pause and ask yourself, do I know how many years I have left on my mortgage right now? Not original term, what is left today? If you don't know, that's your first warning sign. The next question is, did my renewal offer increase in my amortization period? Or did someone suggest stretching it out as the main solution? I'm choosing this just because the payment feels better without checking what's the cost me over time. If you answer yes to any of those, please slow down a bit. Here's what you should do instead. Please find out your remaining amortization. You can actually get it from your latest mortgage statement, or you can call a lender. Sometimes online banking show it, but please don't guess. You need the exact number. Because saying I have 25 years mortgage means nothing if you already hopefully paid 5 years and you're 5 years in. Another thing is, tell your lender you want a renewal option that keep your current amortization, because you want to be able to compare what makes more sense for you. For example, I have 20 years left, show me rates and payments based on 20 years. And also know how much interest you're going to pay if you're going to extend the amortization. This keeps the conversation super honest, and you are comparing basically apples to apples. If you need to reduce your payment, don't just jump to 30 years amortization. Instead, ask your lender, what are my options if I increase my payment a little instead? Can I do accelerated biweekly payments? Can I make a lump sum payments without penalties? Can I increase my payments annually? Are there flexibility prepayment privileges? Because there is a big difference between I need help for a short period of time and I'm absolutely agreeing to pay interest for the next 10 years, or the other, which is a long-term plan to reduce the cost. If you do need to extend your amortization, set a plan to reset it later. This is the step most people miss. If you stretch your amortization to ease payments, that's okay, but you need a clear trigger to increase payments again. Let me give you an example. Let's say when your child daycare expenses end, will you be able to increase your payment? Will your car loans paid off? Will you be able to contribute more to mortgage? When you get your next raise, can you pay more to your mortgage? When the interest rate drops, maybe you can pay more towards your mortgage. You need a plan that says this is temporary, because if you don't, the years will start adding up and the interest will start accumulating. And before you know it, you've been paying for 12 years, but your mortgage balance is barely moved. So to wrap this all up, if you remember one thing from this video, remember this. The biggest mortgage mistake, it's not choosing the bad rate. It's resetting your amortization. It feels small in that moment. It feels like just lowering your monthly payment, but over the time, it can cost you around $127,000 or more. So before you renew, please do these things. Know your remaining amortization. Please compare options without extending it. And if you do extend it, please have a plan to reverse it. I hope you enjoyed this video. See you in the next one.